So Woody, welcome to The Pulse.
Thanks, Ed. It's great to be with you today.
As a leading investment management firm specializing in insurance, you keep close tabs on industry financials. So tell us, how is the investment environment for insurers?
I think I need to start with the US economy first for insurance companies, which we're pretty constructive on right now, even with all the volatility that we're feeling day to day in the markets. We're looking for around 4% expected growth in 2022. That's down a little bit from the 5.5 plus that we saw in 2021. But we think demand in the economy remains strong. We think corporate balance sheets are healthy and fundamentals of earnings look pretty good. We're constructive on improvements in employment that we hope to see over the course of the year. Even with the end of fiscal stimulus, we think a combination of high vaccination and inoculation rates and weaker variants will allow people on the sidelines to return to the workforce, and that will help. Of concern, I think, in front of mind for a lot of people right now is inflation. And inflation is real and it needs to be addressed. It was fueled by a whole host of things, starting with supply chain disruptions and some challenges in the labor markets. But we think that as the COVID-19 virus goes from pandemic to endemic at some point over the coming months and quarters, those issues that got in the way of our supply chain should improve. And in response also to inflation concerns, the Fed has signaled they intend to take important steps to address inflation. They've said that they would also end their long-term program of buying securities likely this spring and raise rates. The number and size and timing is still uncertain, but the marketplace today, I think, is pricing in about 3.5 rate increases through the end of year 2022. All of those actions and all of those words are feeding interest rate volatility and market volatility, but we do hope that those will be actions that will slow the progress of inflation as the COVID-19 virus becomes again more of an endemic and less of a pandemic. It does leave us at Conning worrying about a policy mistake here, which could be very disruptive, moving too quickly, not moving quickly enough. I think the marketplace generally thinks the Fed's a little bit behind the curve here, and they're playing catch up in terms of trying to slow the economy. Another important point I think to mention beyond inflation is an obvious one that 2022 is an election year, which generally sees fewer major legislative changes, which can be good. It's more stability. It looks like the Build Back Better plan, which didn't pass last year, could be revived in a much scaled back form as we go forward, but we don't really anticipate any destabilizing policy actions on the fiscal or monetary front out of Washington over the course of the next number of quarters. So generally pretty constructive on that basis.
Good. Well, thank you. Let's stick with inflation. I think everybody knows about the formula for inflation, where too much money chases too few goods. How is inflation affecting insurers and their customers?
Yeah, inflation, it presents a pretty meaningful risk to property and casualty insurance companies. But you have to separate things a little bit. The near-term inflationary shocks that we could feel, like the 7% number that's been widely covered in the press a couple of weeks ago, has nowhere near the same impact as sustained changes to the term structure of inflation. And what I mean by that is multi-year inflation higher than 2%, which could be very damaging to insurance companies. Aside from the risk that inflation presents to investment portfolios, there's pretty material risks to insurance companies from inflation on two sides. One is liabilities. Obviously, insurance companies carry liabilities in the form of loss reserves that are intended to pay claims in the future. And if inflation is higher than the rate that was built into those loss reserves, then future payments will be greater than expected. And the second piece is pricing. Insurers charge prices today that are designed to pay for future claims. And so if inflation proves to be greater than the inflation rate that was anticipated in prices, then we have a problem there. The impact is obviously more meaningful on longer lines of business like workers' comp or medical professional liability, where the payout patterns are longer and a lot less damaging to shorter tail lines of business. If you look at the balance sheets of property casualty insurers, historically, they haven't held many assets that were pegged to inflation, things like TIPS, due to the historically low yields. But we have seen an increase over recent years in securities with floating rate coupons, which can reset with higher rates, which do prevent a bit of an offset to higher rates. And growth assets like equities also historically have shown some offset to inflation risk. For property casualty insurers, for inflation to be a meaningful capital destruction event for the industry, we would need to see a multi-year period of sustained inflation. It's just not in our base case today. It's certainly a risk, and it's one worth thinking about, but it's not at all in our base case, and we wouldn't ascribe a high probability to it today.
Okay. Well, obviously, inflation is one piece, but there's other pieces that are challenging. So what has your team been talking to insurers about in terms of managing their portfolios this year?
Yeah, challenging environment, of course, and lots of discussions, especially over the last handful of weeks with the inflation prints and with volatility in the marketplace. We at Conning always tend to go back to think about what the purpose of the investment portfolio is. We like to work with our clients and start with helping them building investment strategies that address their business needs, which can usually vary a lot company by company, depending on the line of business, the regulatory environment, capital standards, et cetera. But from a high level, what we like to start with is helping them think through how to manage and take risk in their investment portfolios. And first, and perhaps obviously, we encourage our clients to take a very measured approach to risk. With the inflation concerns and rates probably rising over the coming quarters, higher rates present, I think, a welcoming opportunity to generate more income, and the temptation might be to lock in as much investment income as possible. But being very cautious about duration risk and credit quality right now really matters. So at this point, we're thinking about, with this current market environment, building duration in higher quality ends of the market, like taxable municipals and high quality corporates, and trying to balance that with more risk-taking, lower quality securities, triple Bs, double Bs, and private placements with shorter duration risk. So really separating where we're taking credit and duration risk. We've seen, I mentioned it earlier, floating rate securities, collateralized loan obligations or CLOs, and bank loans have been a nice complement to this strategy, giving their floating rate nature, which allows them to absorb interest rate increases and benefit the portfolio. Last thing I'd say is that while there are some investments that should perform better in a rising rate environment, specific securities or investment ideas, the most important thing for an insurance company to do is to make sure the entire investment portfolio will support the liabilities in a rising rate environment, in a flat rate environment, and a falling rate environment. So that strategic asset allocation analysis, or SAA, modeling that against the liabilities under different scenarios is probably the most important thing to get right.
Thank you. Talking about that, the availability of capital has an impact on our industry, and much of it flows through the reinsurance space. How does the alternative capital market look, and how is it affecting reinsurance and insurance pricing for that matter?
It's been interesting. Alternative capital, and even that name is maybe a little bit of a misnomer now, given all the advancements we've seen. But alternative capital has become very much mainstream. I don't think we'd call it mainstream capital, but it's widely covered, meaning that a typical component of many companies' seeding programs includes some component of alternative capital, or what could be referred to as alternative capital. Some estimates represent that about 17.5% of total reinsurance capital at the end of last year was alternative capital, and that's a share that's held pretty constant since about 2016. So pretty sizable component. Some people refer to this now as insurance-linked securities, or ILS, which comprises, a collection of things: cat bonds, collateralized reinsurance, sidecars, industry loss warranties, et cetera. Collateralized reinsurance is the biggest piece of it. In terms of the dynamics, the quantum may not be as important as how it's allocated. So a lot of flows into the retrocessional market, which was pretty tight this year or last year, and with risk-adjusted retrocession catastrophe excessive loss rates online up about 15% on average. This has led to a price hardening in the global property cat reinsurance market, which is up by some estimates about 9%. So that's pretty interesting. The cat market, the last thing I'd say is that alternative capital is looking fairly disciplined, having been stung by some cat losses in the last couple of years, but the pain of those losses has really been unevenly distributed across cat sources. Cat bond investors have been so far largely unscathed. So, we'll see what happens as we go forward, but it's been interesting to watch for sure.
Well, given all that, how should insurers view their investment strategies as a result? Should they reconsider their allocation of assets, say, into alternative investments?
So at Conning, we believe that insurance companies need to build portfolios that help them meet their business needs. I said that a few minutes ago, as well as their tolerance for risk. So to answer any question about specific asset classes, I always step back and say we need to focus on making sure we have a thorough understanding of what the asset allocation is that fits our business needs and fits the strategic framework for that specific insurance company. So we work with clients to conduct a strategic asset allocation analysis that's intended to help them do just that. And it identifies the types of strategies that can be included in the portfolio that meet the business needs and a risk tolerance under a whole range of scenarios, rate scenarios, different market environments, et cetera. We have been consistently, to your question about adding strategies, encouraging clients to diversify their investment portfolios well beyond the traditional assets of treasuries and high quality corporate credit and the like, as that helps them better manage market volatility. Or said another way, to put it in a different lens, I guess, adding different sources of risk and return to portfolios helps increase the odds of a positive outcome and leads to a more efficient portfolio as we go forward. Clients have been faced with an extended period of low yields here, even with all the noise about rates rising and inflation. And that's really squeezed net investment income on these traditional staple investments. And as a result of that, many of our clients have been looking for opportunities with more yield and been more willing to consider trading some risk and trading some liquidity to get more yield. And so for insurance companies, alternatives to the traditional strategies they might consider include things like high quality collateralized loan obligation securities, private placements, or even some less mainstream asset-backed securities. And then a step beyond that would be a whole category of perhaps more referred to as more aggressive alternative investments, broadly called private credit. You could drive a truck through the definition of private credit, and different firms have different ways they want to talk about that. But there's a whole set of opportunities as banks have stepped back from different forms of lending that private lenders have stepped into that have created opportunities for insurance companies and other investors to work with. As you get into these more complex and sometimes more opaque investments, it's more important to very carefully consider the regulatory requirements and risks, the skills that are required to properly oversee and manage those investments, either internally or with a trusted outside partner. It's important to think through the steps of educating not just your investment committee, but your board of directors as you invest into new areas as well. So a lot to consider as clients step down this path of thinking about different sources of risk and return and how they can impact back that overall strategic asset allocation that can hopefully in many scenarios lead to a better outcome overall.
Okay, well, going down that path and talking about diversification of portfolios, we've been hearing a lot about cryptocurrency and digital assets in general. Yeah, what do you think? Should insurers invest in them?
Yeah, my short answer is generally no, at least not yet. You probably get different answers from people on crypto depending on what week it is. The moment that you and I are having this conversation, it's not looking so great. And about 6 weeks ago, it looked fabulous. I still would say no at this point. I have seen, interestingly though, a number of platform opportunities as an asset manager that's constantly looking for new ideas for our clients and for ourselves. And it reminds me a lot, Ed, of the 1998, 1999 period when the telecom infrastructure was being built and white hot. And you think about the .com and the internet companies that were white hot then, but there was a ton of money that went into the infrastructure to support telecom and to the internet. And even though many of those investments didn't pan out, that infrastructure remained in place and really fueled growth coming into the next decade. And I think there's a number of parallels that are really interesting. And it's notable that a number of insurance companies, particularly life insurance companies, have made some small, proportionate to their balance sheets investments that I would call more strategic in nature in the crypto universe. The exposures that we see today seem more aligned with learning and wanting to participate in an ecosystem than they seem to be, a big bet on whether crypto is going to the moon or not. But I think that we will see more infrastructure. I definitely wouldn't be surprised if we see more ETFs, more indices, more structures, more vehicles as we go forward. And I'm quite sure that we're going to see a lot more regulatory involvement. And I think for insurance companies, I'd like to see a lot of that settle out before I saw any real money getting invested in crypto or digital assets.
Okay, thanks. I know another area of investing you feel strongly about is ESG, or environmental, social, and governance. And in fact, Connie just wrapped up a survey with U.S. insurance organizations on the topic of ESG. Did you learn anything interesting?
Yeah, we did. And it's the whole category of environmental and social governance concerns is one that's growing and become much more important across our whole society in the United States and around the world. And so the survey was well received by those we offered it to, and we did learn quite a bit. U.S. insurance companies are rapidly becoming more engaged in adding ESG principles to their investment practices. Of those we surveyed, 79% said that they began incorporating ESG factors into their investing practices in the last 2 years, and 41% in the last 12 months. These are huge, huge numbers and a big change. 92% of respondents from property casualty companies said that their company had implemented some sort of ESG consideration, with over 80% of the respondents saying they added it within the last 2 years. Again, very big numbers amongst the property casualty industry. Now that said, some other interesting pieces as I sort of peel the layers of the onion a little bit. 70% of respondents from property casualty companies were either concerned or very concerned about ESG investment constraints. And so really, what does it cost me? If I invest in an ESG way, what does it cost me? What are the limits? Well, how does it hurt me? But those concerns really didn't rank high compared to other concerns that were expressed, like inflation, market volatility, the impact of fiscal policy, of monetary policy, changes to risk-based capital charges. So a big trend toward adopting ESG, some concern about the constraints, but a lot more concerned about some of the other macro factors. I would say we service insurance companies all over the world, and generally US insurance companies are playing catch up relative to where European and many Asian counterparts are, with more disclosure, more specific additions to their investment guidelines. But even without, sort of playing from behind a little bit, I would commend U.S. insurance companies' efforts in the absence of specific standards and requirements. And there are no really specific standards or requirements. 59% of the respondents in our survey actually said it was hard to know exactly what standards were being applied from an ESG perspective. So a fair bit of confusion. And, I think that when we've tried to look at the survey results and talk to many of our clients and the respondents about it, I think there's a mix of people from an ESG perspective who are being responsive, and there are some who are being more proactive. And the responsive side, I think, is largely at regulatory in nature, the people who are responding to their ORSA or the AM Best survey questionnaire or the New York Department of Financial Services, who have questions about transition risk. But interestingly, for me at least, from the survey, 91% of respondents said that the potential impact on corporate reputation was either important or very important, and was a key factor to make them think about ESG. And so you might think that could be defensive, avoiding negative publicity, but I actually think that it's equally offensive, thinking about the positive publicity of doing something right in the eyes of your customers, in the eyes of your employees, and for the leadership team and the board. I would say that there's another element here that I think that we're all still trying to understand, and that's that ESG risk doesn't 100% equal carbon risk. And it's worth drawing that distinction a little bit. There's a lot of overlap for sure on the environmental side, but so far from what we've seen and heard from our clients, the main concern from the regulators has been revolving around the financial risks associated with climate change rather than ESG more broadly. I think the Fed's very focused there. The New York Department of Financial Services certainly is. The NAIC's Climate and Resiliency Task Force is. So I think where regulators are, versus where companies are trying to focus for their employees and their customers has some overlap, but there's a little bit of difference.
Well, there's a lot in that survey, everything, as you mentioned, from confusion to a lot of concern about reputational risk. What are you telling your clients in terms of how do they incorporate these ESG principles into their portfolios?
Yeah, because there's no sort of single standard out there or no single best practice, we usually start by telling our clients that it's a journey. And so get ready for a journey. And it's one that starts with education and understanding for your investment teams and for your board. We believe that investment strategies, maybe it's obvious, need to be designed and adjusted in a deliberate and an informed manner, not in a snapback or a quick responsive kind of manner. So, every investment professional out there overseeing a balance sheet has a set of investment objectives they're trying to meet. And those are becoming more challenging with rates moving and more risk to the economy in front of us. Our view and our advice on that journey is that ESG should not start in the investment portfolio. It really should begin at the enterprise level and flow to the portfolio, flow to the guidelines, flow to the strategy from the top based on what the company wants to try to accomplish. And without that, you'll end up seeing investment tactics that are all over the map. And I give you a few examples off the top of my head. Along with active strategies in ESG, we have seen ESG labeled bond sleeves. We've seen carbon emission reduction objectives. We've seen divestment objectives. We've seen specific transition risk reduction objectives all over the place. And so I go back to that basic point, which is step back and have a game plan for the company. Try to be as clear as you can about what you want to accomplish from an ESG perspective and which principles are most important to you, and translate that into objectives for the investment team and in the investment portfolio to help them avoid wasting time chasing shadows given the lack of market standards that exist.
I think most P&C executives understand how climate change might impact their underwriting portfolios, but you believe insurers need to better understand how different scenarios might affect financial markets and their holdings, right? And how so?
Yeah, understanding different climate scenarios on investments can be very challenging. We just talked about the fact that there's limited standards. When you talk about climate, there's limited historical data available on climate risk. There's obviously tremendous uncertainty about policy responses and how governments will respond to different scenarios. The questions about time horizon used to measure risk. So we like to pursue a stochastic approach, and stochastic is just a fancy word for sort of a random distribution approach. Single point scenarios we think are pretty useless when you think about climate risk and carbon risk in particular. Looking at temperature is going to be up 2 degrees. What does that mean? We really think it's important to look at a stochastic approach to thinking about climate risk. We've actually at Conning developed a climate risk analyzer tool that models out a stochastic approach to helping clients look at their portfolios from a range of different scenarios and perspectives. It's a much longer conversation, and there's a whole pile of folks on my team who are a lot smarter than me talking about this stuff. You can find some more information about it on our website under the software tab if you're interested. But I think taking that stochastic look is really important. There's many factors that impact the level of climate change risk that different insurance companies face in their portfolios. And with these shorter duration portfolios that are generally the case for property casualty insurers, there's a whole set of things to focus on. There's technology risks associated with the technological shifts in products and energy consumption that we see moving to a low carbon economy. There's policy risk, regulatory and legal aspects that are going to differ by jurisdiction and lead to different strategies and different implications for portfolios. There's physical risk as you think about cash flows that come from higher payouts on different liabilities and the impact on different investments as well. So on top of that, inside client portfolios, it's critical to look for stranded assets or assets whose values could decline in a less carbon friendly environment or fall out of favor, or quite the opposite, assets that could become very valuable in a low carbon environment. We try hard not to impose a moral view of an industry or of an issuer in our work with clients. It's not intended to be an exclusionary exercise for the portfolios. It's really meant to be a process to help our clients understand how climate risk impacts portfolios under different scenarios and to help them think about where they want to take risk, where they don't want to take risk. And going back to what we talked about earlier, how that fits into the overall ESG objectives and principles and values of the company before setting specific tactics, and then go from there.
Great. I have one last question. As you know, the pandemic pushed many companies to work remotely, as Conning did. And as you know, at AAIS, we went to a remote workforce several years before the pandemic, so little has changed for us. But Conning is, as I understand it, like many companies, hoping to return to their offices as soon as next month. What was behind your decision, and what will it take to make your colleagues feel safe coming back into the office?
Yeah, you were leaders, and I give you credit for doing what you did. If you think back to just 2 years ago, so many companies, ours included, if you thought about working in a hybrid model for more than a few days, it seemed to be life-changing. We do hope to return to our offices starting in March. But if we've learned anything over the course of the last 2 years, it's that remaining flexible is, the key to success here. For us, the most important point throughout all of this has been a focus on keeping our employees and their families healthy and safe. And that's a combination of both physical and mental health. And to support that, we've tried to be as transparent as we can with our employees about what we were thinking and why. And that's been to give them as long a lead time as we can before making changes to try to avoid the stops and starts. So we've done our best to study the data. We try hard not to watch any news programs to make decisions. We try hard to look at the underlying data and avoid making rash decisions about working in the office or not. And we've honestly been able to learn from other people's first steps and mistakes to help shape our plan as we go forward. We're fortunate, as I think many of our clients have been, that we've had a largely successful experience in working remotely. And it's been, I think, really a credit to the tremendous effort of my team and our colleagues at Conning, who've done just an extraordinary job of serving our clients and helping each other through just an extraordinarily difficult time, both personally and professionally. I'm just very grateful to each and every one of them. And I think our strong culture of collaboration and teamwork has been a critical part of what's gotten us through that. All that said, I think that, and we as a leadership team believe that in the investment business, it's hard to sustain important aspects of a corporate culture and to grow and develop people in 100% remote format. So we believe that it's important to have a combination of time together at the same time that you're providing people flexibility as we go forward. Longer term, that could change with the current state of remote work technology. I think that culture and development and connections could erode if we were to be 100% virtual. And it could be, my kids and some of their friends have the goggles that they put on and that's 100% virtual. It could be that in 5 years, we're all sitting home in our basements and that feels like we're right in person, but that's not for me and for us. And we're not there today with our technology. We think that, there are important questions and important apprenticeship learning that happens in our business that you just can't as easily get or as quickly get through a Teams or a Zoom or some other format. So for us, we intend to balance those two by having our return to office for US employees feature a hybrid model with 3 days in the office and 2 days flexible. Folks could be in the office or not. And we're obviously working to stay as up to date as we can on, federal and state and local laws and rules. It's a new world for all of us, I think, Ed, and we're, watching it closely. We're trying to see what others do and learn from it. We're listening to our employees and what works and going to continue to focus on that principle of focusing on the health and safety of our employees and being flexible because this is the first pandemic we've all been through.
Great comments. Well, Woody, that's all the time we have for today, but I want to thank you on behalf of all of our members so much for being part of the Pulse.
It's our pleasure, Ed. Thanks very much for having us.